All right, so this is late night thoughts. AMC. So we're gonna talk a little bit about AMC and what's really gonna cause the squeeze. Okay, I'm just like you. I'm trying to figure out what's gonna cause the squeeze. A lot of us are thinking, what could cause a squeeze? Is it gonna be a share count? Is it gonna be a merger? None of that stuff matters. Okay, the ultimate thing. This is a liquidity play, you guys. I did a video on this, a longer form video. This is a liquidity play. The shorts are going to short this thing until they literally have no money to short it, right? Like, we've made this like a vendetta thing for them. They want to prove that Wall Street insiders are always going to dominate retail, which we know that's not really happening right now in terms of this play because they are losing money on this play right now. But it's fine because they still have liquidity. Once they don't have that liquidity anymore, once the credit line gets cut, reduced, once the market starts to come down and those assets that they're using to collateralize to get more liquidity become shortened, that's when you'll see AMC run. You're not going to see AMC run because there's a merger. They have the liquidity fairy, right? Like you listen to Lou, you listen to AMC Bigums, you listen to Thomas James Investing, a Mass Investor. You know all the different players that have been talking about this. The one thing you have to focus on, you don't have to listen to all these different narratives that are being pushed in. This is very simple. It is a liquidity driven play. The only reason they're able to do what they've been doing is because they've had the liquidity to do it. We know that liquidity has been getting systematically drained out of the system. We know the Fed is tightening. We know the bank runs are causing money to be shifted around into other portions of the banking sector. But ultimately, the liquidity is what it comes down to. It's going to come down to them not literally having the money to be the excess money, because this is not their only play. This is not their only gig, right? Like, they're in other plays. AMC is not the only thing that they're into, right? So we got to remember, this is not just because this may be the play that you're into and this may be the only play that you're into. This is not the only play that they're into. They're fighting these other fronts as well. So as that liquidity dries up for the hedge funds to be able to short this, and you can say, oh, well, they can just keep making shares. And yeah, they can keep making shares, but they can't. They have a limit on how much money that they can get leveraged to them. And that's what we're waiting for. We're waiting for that event, that credit event to happen. We've already had credit events. You're going to see more credit events. What that black swan is, no one knows, right? That's why they call it a black swan, because it's an unforeseen event. Now, obviously, we know what part of the field it may come from, right? But nobody knows what's going to be the catalyst trigger, right? You have Credit Suisse. What happened to them, right? Well, we figured, oh, well, Credit Suisse, if Credit Suisse goes down, they're funding a lot of these hedges. Man, it's gonna go ahead and implode everything, and then to the moon. Guess what? That shit didn't happen. Credit Suisse is done for. 160-year-old bank. You know what they did? They changed the fucking rules. They changed the fucking rule. The country changed the fucking rules. It's a cardinal sin that they committed. Equity always gets stripped and bone dry before the creditors do. Right? The key is that you have to understand that desperate measures calls for desperate times. We're in desperate times. That's why a 160-year-old bank went under, and to make sure that the whole market, because they're systemic to the whole market, their counterparty risk And I talked about that also. Unknown counterparty risk. Check out the AMC video. I talk about all that stuff in there. I break that down. But you had a 160-year-old bank that went bust, and the country literally changed the rules so that they were allowed to maintain whatever positions they had, but to clear out the debt. And was it a political thing? Yes, because you had a lot of Middle Eastern money that was invested in that company directly. So you think that a lot of that Middle Eastern money was in other areas and in other companies within that Swiss banking system? Of course. You think that they were just going to wipe them out? Of course not. Too much money housed there. Money that's for investment purposes, money that's just to keep as dry powder, assets that are held. It's way bigger than you see just on the news and the media. That it's way bigger than that. They're still trying to wind that down right now. That debt, just because they announced it on TV, it's not going away. $18 billion in debt. They said, oh, well, it's done. So UBS said, well, we only will take this if you guys clear that out. You think that just disappeared? Yeah, it disappeared in terms of value and got marked down. But there are certain parts of that that were chopped up into little bitty tranches, and they were partitioned out and sold at pennies on the dollar. Somebody bought it because they said, well, it's still worth something. Somebody's going to believe that some of that debt is worth something. The whole 18 didn't just get wiped off the planet. There's counterparty risk to everything. That's why if you're getting ready for this ultimate crisis that's coming, you got to have assets that are not based in counterparty risk, right? That means that there's no other party that is there to substantiate the value, right? That's what securitization is. There's one party that's over here and they said, hey, I got this thing that's valuable. I'm going to give it to you in lieu to get access to capital, right? So what does that mean? That means you're probably going to have a commodity, right? You're probably going to have real estate, right? It means that you have the real estate. Now, if you have a mortgage on that real estate, there's a counterparty risk, yeah, that the bank could go under, and that, yeah, in the United States at least. I know somebody may be looking at this overseas, but in the United States, they could call that loan, right? There's always a clause in the loan, in the mortgage, where they could call that loan, but they're not going to do that, right? Because they know that that would absolutely implode the real estate market if, let's say Bank of America went under, right? So I know a lot of rumblings on Reddit have been talking about that, right? So rumblings about Bank of America being the big bank that may go under. But we know it's not going to go under, right? Credit Suisse should have went under, right? But they didn't go under. But they're done, right? Like they really don't exist anymore. They're a shell of what they were, right? They're just there in name, but those assets are being sifted through, pulled out, right? Just like, if somebody was pulling out a tick off of a dog, right? They're pulling them out. They're picking and choosing. They're going through all the hair and the weed, and they're figuring it out, right? They're digging through the weeds to figure out where are the gems, and they're discarding all the other stuff because they can't keep it. They can't take on the debt load without the liquidity, and then risking all the counterparty agreements, stock, credit bets, bond bets, all those things. It's too much to just unravel a company like that. You can't do it. So again, AMC is a liquidity play. Don't care what Aaron does right now. The dilution is just going to kick the can. Like they still have to go ahead and shift all of that money somewhere, right? They're just going to kick the can though when they do it. They haven't closed out the position. And when that liquidity crunch happens and there's margin calls that happen, that's when you'll see it. So if you're looking to see when you're going to go to the moon, keep looking at the banking and credit markets. You know, as a stockbroker, one thing I learned early on from a mentor is that you want to know the best people to follow on Wall Street. Follow the people that are the bond traders. Why? Because their risk is priced in differently than how you price in equities, right? Equities, the CEO could catch a cold and the stock goes down, 100 points, whatever. So you don't really have that in the bond market because it's built on larger numbers. And just remember, in the bond market, there's 30 days of trading in the U.S. stock market that would happen to equate to 1 day in the bond market. So it's a lot bigger, a lot larger of a market, and there are things that have to move that market that are it's like moving, let's say like the economy is like an aircraft carrier. Like you're trying to steer an aircraft carrier, can't turn on a dime. That's how the bond market is. It can't turn on a dime, but things do happen quickly to make snap judgments. But since you have something that's based on a term and a rate, it's something that's fixed, right? Like there are much more known variables that are understood that have to be understood when it comes to the bond market. And equities, there's just so many variables that could come in to place. But bonds, not really the same, right? It's a fixed instrument. Obviously it can be variable, but I mean, innately, it is an instrument that has a certain parameter that's set in a certain understood expectation. And if that expectation is taken away, then obviously you see a drastic move in pricing. But that usually you can kind of see those coming up, right? Like you'll see that. Equities, it's a different beast you're dealing with, much different beast. And most people, learn about the stock market. They don't learn about bonds and credit markets. All these default swaps. The only reason you hear about these things now is because they're blowing up, right? And that's what blew up part of the industry back during the great financial crisis. But, these things are still out there and they're going to affect this AMC play, but it's going to come down to liquidity, folks. All this other stuff that you're paying attention to, the lawsuit, the judge putting the order to halt everything for right now. It doesn't matter. The case could be closed tomorrow, and then Adam Aaron issues X amount of million more shares. It wouldn't even matter, right? Because the synthetics are most likely in the tens of billions, right? Tens of billions that they have. It's a liquidity play, folks. Hold on. Pay attention to the bond market. Pay attention to the credit markets. Pay attention to the regional banks. That's what you want to look at. Have a good night.